If you get Social Security, SSI, or SSDI, pause for a moment and pay close attention. A significant new banking-related change is quietly being introduced across the United States, and millions of seniors don't realize it could directly affect when and even how you access your monthly payments. We're talking about your essential income, the money you rely on for food, medication, rent, and daily living. This isn't speculation, it's not political noise. It's a real shift in banking practices that experts say could be one of the most impactful changes to hit benefit recipients' accounts in years. Could your deposit arrive late? Could your account be temporarily restricted without warning? Could new identity checks prevent you from accessing your own funds? These are not small questions, and they need answers now. In this guide, we're going to walk through everything in clear, simple language. No complicated banking terms, no confusing policy talk, just practical information to help you protect your money and your peace of mind. Let's get started. First, some background. How did we get here? For decades, the U.S. banking system has operated under rules designed to protect consumers, especially those on fixed incomes like Social Security, SSI, and SSDI recipients. These protections came from hard lessons: financial crises, bank failures, and situations where people lost access to their money through no fault of their own. The system wasn't perfect, but it had safeguards. For most benefit recipients, that meant one thing: your monthly deposit arrived on time, landed safely in your account, and was ready to use without any issues. But things are changing. Over the past year, federal agencies have been holding discussions behind the scenes. Organizations like the Federal Deposit Insurance Corporation, FDIC, the Consumer Financial Protection Bureau, CFPB, and the Office of the Comptroller of the Currency, OCC. These agencies oversee how banks operate, and the policies they've been reviewing directly impact how banks handle government benefit deposits, verify account activity, and respond to potential risks. Most people never hear about these discussions because they happen in technical reports and policy meetings. But the effects, they show up in your bank account. So what exactly is this new rule, and why does it matter? In simple terms, it centers on stronger account verification and fraud prevention systems. Banks are under increasing pressure to reduce fraud, especially fraud targeting benefit payments. Billions of dollars have been lost due to identity theft, fake accounts, and fraudulent claims. That's a real issue. But the way banks are responding is creating unintended consequences for legitimate users, especially seniors who've been receiving benefits for years without problems. Here's what's happening in practice. If a bank detects something it considers unusual, like a change in deposit patterns, account activity, or identity signals, it may flag the account. When that happens, the bank can place a temporary hold on deposits, review the account, and in some cases, restrict access until the issue is resolved. For some people, that might just feel like a delay, but for someone depending on that money to pay rent or buy medication, even a short hold, 3 to 5 days, can be serious. We're talking about missed payments, skipped meals, or delayed prescriptions. This is not a minor inconvenience. Now let's talk about another layer: Know Your Customer, or KYC rules. These requirements already exist, but they're being expanded. Banks are required to verify customer identities and ensure accounts are being used properly. For people who regularly use apps, check emails, and respond quickly, this process often goes unnoticed. But for many seniors, it's a different story. If you don't use a smartphone, rarely check email, or don't see a message from your bank, you could miss an important verification request. And that can lead to problems. Let's make this real with an example. Imagine Dorothy, a 74-year-old woman. She's lived in the same apartment for 15 years. She's had the same bank account for over 2 decades. Every month, her Social Security payment arrives like clockwork. One day, her bank sends an email asking her to confirm her identity as part of a routine update. She doesn't see it. A couple of weeks later, her account is placed under review. Her deposit arrives, but she can't access it. When she visits the bank, she's told she needs to provide identification and proof of address. Eventually, the issue is resolved, but not before she misses a payment and goes several days without access to her money. This isn't hypothetical. Situations like this are happening right now. You might be wondering, aren't Social Security payments protected? Yes, they are. Federal law does protect benefit payments in certain situations, especially when it comes to garnishment. when creditors try to collect debts from your account. In those cases, banks must protect a portion of your benefits. But here's the key distinction. Those protections apply to debt collection, not to bank compliance reviews. If your account is flagged for identity verification or suspected fraud, the bank is allowed to temporarily restrict access while they investigate. That's a completely separate issue under the law. Understanding this difference is critical. Now let's talk specifically about SSI and SSDI recipients. SSI is designed for individuals with very limited income and resources. Payments are smaller, and recipients are often among the most financially vulnerable. For someone in that situation, even a short delay can be a crisis. And unfortunately, SSI recipients may face additional challenges, like limited documentation, shared living arrangements, or less access to digital tools needed for verification. SSDI recipients face a different set of difficulties. Many are managing serious health conditions that make it hard to respond quickly to bank requests, travel to a branch, or complete paperwork. Some may deal with mobility issues, cognitive challenges, or mental health conditions. These systems were built to prevent fraud, but they don't always account for these real-life barriers. So, what can you do right now to protect yourself? Let's go step by step. Step 1. Update your contact information. Make sure your bank has your current phone number, address, and email if you use one. This is simple, but extremely important. If the bank can't reach you, you might miss a verification request until it becomes a problem. Step 2. Learn your bank's policies. Ask your bank directly how they handle benefit deposits. What triggers a review? How long can it last? What documents would you need to resolve it? Write this information down. Step 3. Consider a small backup fund. If possible, keep a small amount of money in a separate account. Even a modest buffer can help you manage if your main account is temporarily restricted. Step 4. Keep key phone numbers handy. Have the contact numbers for your bank and the Social Security Administration written down somewhere easy to access. If there's an issue, acting quickly matters. Step 5. Add a trusted contact. If you have a family member or friend who helps with finances, consider authorizing them to speak with your bank. This can speed up problem solving if you're unable to handle it yourself. Now, what about switching banks? Some people are considering moving their accounts to institutions they trust more. That's an option, but it requires careful planning. You'll need to update your direct deposit with the Social Security Administration, which can take 1 to 2 payment cycles. During that time, your old account must stay open. If you do switch, confirm everything is set up before making changes. Credit unions are also worth considering. They're member-owned and often provide more personalized service. They're also insured, just like traditional banks. Finally, we need to talk about scams. Whenever there's confusion, scammers take advantage. You might receive a call claiming your account is at risk and asking for your personal information. Remember this, no legitimate bank or government agency will call you out of the blue asking for your social security number or account details. If you get a suspicious call, hang up. Then contact your bank or the Social Security Administration directly using official numbers. One last reassurance, your money is protected. Most bank accounts are insured up to $250,000. Temporary holds are about verification, not about your bank failing. Let's wrap this up. We covered how new banking practices tied to fraud prevention could lead to delays or temporary restrictions on benefit deposits. We explained the difference between legal protections and compliance checks. We talked about the specific risks for SSI and SSDI recipients, and we outlined 5 practical steps you can take right now. Most importantly, remember this: you are not powerless. Yes, the system is complex. Yes, the rules are evolving, but you have rights, you have options, and you have the ability to protect yourself. The more informed you are, the better prepared you'll be. Stay aware, stay cautious, and take care of yourself and the people who depend on you.